The cost of capital is the return that an investor or CFO will demand for the financing of a business or line of business, and it represents a hurdle rate that the company must overcome to create a surplus of value. When an investor values a company, there are two key inputs: 1, estimated cash flows, and 2, the cost of capital. The lower the cost of capital is, the more valuable the cash flow is. The cost of capital is the weighted average of a company's cost of debt and equity. One of the most widely used methods for calculating a company's cost of equity is the Capital Asset Pricing Model, also known as CAPM. This model relies on three variables to quantify the return one should expect from investing in a company: 1, the risk-free rate; 2, beta; and 3, the risk-equity premium. First, the risk-free rate is the hypothetical rate of return of an investment with no risk of loss. Second, beta is the tendency for an asset to move in accordance with the general market. Finally, the risk-equity premium is the return in excess of the risk-free rate that an equity investor requires as compensation for taking on the relatively higher risk of the equity market. The beta of a portfolio of litigation-related assets should be 0 or extremely close to 0. If this is the case, then cost of capital to finance a portfolio of litigation-related assets should be the risk-free rate. Risk-free rate plus 0 * equity risk premium equals risk-free rate. As litigation finance continues to grow, it will be intriguing to see how the cost of capital will change.